If you like to watch the world burn, this is not going to be a good video for you. However, if you're hoping for some good news, I think I might have that. We're going to start with the bad because things usually have to get worse before they get better. But in this video, I'm going to talk about why I think 2024 is actually going to be a decent year and why we might see the spring market get pulled ahead into January and February of 2024. My name is Vassil and I'm a real estate broker right here in the city of Toronto. And let's get into the video. I'm going to show you what is happening in real estate right now statistically and what I'm seeing on the ground floor. So let's start with the elephant in the room, and that is the negative amortizations and the fact that a lot of people will be renewing their mortgages in the next 24 months. Why does this matter? Well, right now, if you're with TD, BMO, or CIBC, you're probably in a negative amortization mortgage if you had a variable rate, meaning your payment stayed the same. However, your payment doesn't even cover the interest portion of your loan. That will become a big issue when you renew, because not only are you going to have to pay the accrued interest that you were short during the time you were paying this mortgage, but you're going to be renewing your mortgage at a significantly higher monthly payment. So that is the issue that Bank of Canada is facing and how they're going to be managing over the next 24 months. As of right now, obviously the Bank of Canada held rates, and we're likely not going to be raising rates further. The Feds in the United States are also doing the same thing. David Rosenberg's interpretation of this is that the federal government in the United States is accepting, or they believe that there's 90% probability of a recession. And they're trying to kind of soften the blow as we go into 2024, not wanting to make things worse with further rate hikes. Now, this is likely a sentiment that's shared in Canada, and what this translates to for the real estate market for us here is that we're now starting to see promotional mortgage rates that are starting to look a little bit lower than where they've been in the last 2 months. Like, I'm seeing rates that are similar to what I used to see in September of this year, yet prices are now down roughly 4 to 5% since September. So effectively, purchasing power for the buyer has increased since September because rates are now back down to September's level. However, prices have come down 4 to 5% depending on where you are in the GTA. And you're seeing this on the ground floor because in the last 1 to 2 weeks, buyers have started coming off the sidelines. Some are renewing their mortgages with these new promotional rates, and they're starting to become more active. So here you'll see the trend is going down across most mortgages. Obviously, it's too early to tell, but I think going into 2024, this is going to continue going down as the 5-year Canada bond is also going down. Now, moving on to some of my most sophisticated analysis. As you can see right here, this is a trend line I've done since 2015 because I think realistically, we got to be looking at price increases since 2015. Since then, the market has behaved a lot more similar up until now than the years prior. On average, we've been looking at 8 to 9% median price increases in the GTA since. So let's just assume, had COVID not happened and had interest rates remained at roughly 2%, where we are price-wise is where we technically should have been had COVID not happened and if rates stayed the same. This is important because this gives us an anchoring point where prices should be if things remain normal. Because now we're going to adjust for where rates are today to understand what is the downside for pricing. So for example, let's say you want to buy $1 million house back when rates were 2.5%, let's say 2019 or whenever, let's say 2019, 2018. If you were looking to buy $1 million house with a $200,000 down payment, this was your monthly payment, roughly $3,500, $3,600. Today, a payment of $3,600 to $3,700 per month is the equivalent of a $550,000 mortgage with a 6.49% interest rate. The reason this is important is you can see that we went from purchasing power of $800,000 with this monthly payment to $550,000 with the same monthly payment. So what does that mean? We went from a house that would have cost $1 million, we can now afford a house that costs $750,000. So that is a decrease in purchasing power of about 25%. Back to our very sophisticated trend line, that means the downside in theory from these prices is roughly another 25%. That is not necessarily true because we've had a lot of wage growth as well. So realistically, the way I see it right now, with the current purchasing power erosion, we have probably another downside in prices of about 10 to 15% tops. That is obviously assuming that the economy doesn't go into the dumps. Here is the good news. Number one, new listings are coming down, which is showing us that people are not desperate to sell. They can hang on to their properties. They're probably going to relist in the spring. Nevertheless, they're coming down as per trend. What's more interesting is in the last 2 weeks, a lot more buyers have been coming off the sidelines, putting in offers and starting to look at properties. And this is across most of the GTA. The reason there has been a lot of price compression in the last few months is because we've been selling, or the transactions have been lagging severely from where they usually are. So we've sold roughly 4,200 homes per month during the fall market. Usually we sell almost double that. Obviously that is a big discrepancy, but what is happening right here in December, and what I suspect will happen, is we sell a lot less in December, but I think this trend of transactions going through into December is actually not going to drop sharply. I think it's going to continue downward, but it's going to get closer to where the trend line is. And I think that is going to boost the confidence of sellers and potentially buyers, and deals might actually start to get done. People are more confident to buy now because they don't feel that rates are going to continue going up. Some people are even electing to buy with variable rate mortgages, expecting that they're going to see 2 to 3 rate cuts in the coming year. Personally, I do believe we're going to have a better market in 2024 as early as January and February in terms of liquidity, meaning deals are going to start happening. The one thing I don't know is whether or not prices are going to increase because of it. Obviously, you would assume they would, but I'm still seeing buyers offer, 5 to 10% below asking currently on any property they offer. So there's a lot of buyer discipline. Buyers are not willing to overpay for anything. Nobody's in a really big rush, but at least we're bringing liquidity back in the market and sellers are getting some traction. It's been interesting. And one of the biggest takeaways for me from this market is when you start getting calls from buy-side agents on listings that I recently terminated because they're interested in putting offers in again, or they're asking, hey, when is this listing going to come back up? That is usually a sign I've seen in the past that the market is about to come back up. We never know, but I do expect that January and February we're going to have a lot more action. I hope you enjoyed the video, and I'll see you in the next one.